Well, good morning. Welcome to the Penobscot Financial Advisors version of the Advisor Huddle. And today we have a special guest, Sherri Dyer, who is a mortgage broker or mortgage advisor. She is going to talk with us this morning about all things mortgages. Well, maybe not all things mortgages, but enlighten us. We have some questions that we've given to her in advance, but really we're just eager to hear about what you do and potentially how we can help our clients with their mortgages and HELOCs and all that good stuff. So yeah, I thought we could just start by hearing a little bit about you, Sherri, because this is the first time most of us have met you. And yeah, just about your background and what you do.
Oh, great. Nice to see all of you today. So I'm Sherri Dyer. I own MDI Mortgage, and it's based in Bar Harbor, Maine. I lend anywhere in the state of Maine, primarily Hancock, Penobscot counties, and further afield is more a referral base, past clients, sending family and so forth. I don't do a ton of advertising. Similar, I think, in some ways to your company, small, independent, which I think offers some flexibility and different options too. So I've been in banking for a number of years and used to manage the mortgage departments at a few of the main regional banks. And in the early 2000s, found myself in New Hampshire, where I started working for a national mortgage company, which I hadn't done, and in their wholesale division, which I had never done. So we were taking in thousands of applications from mortgage brokers all over the New England area. And it really opened my eyes to the possibilities and benefits for people to work with a mortgage broker. And really just wanted to move back to Maine. A little tired of bank politics, so decided in 2006 that why not give it a try, see if it works. If not, have to go back to a bank or something. But so far, all is good. And I know I would still come to me if I needed a mortgage. And as long as I can say that, might as well keep going. So that's a little bit about my background. But can't wait to get into the questions.
Yeah.
You have it.
Well, thanks for that. So are you originally from Maine?
No. My family moved here when I was 4.
Oh,
so
gotcha. Well, you're basically from Maine.
I'm not a Mainer. But I love it here.
I am not originally a Mainer. I think Karen Elise is not, but so you're in good company. Well, we can just go through the list of questions. They're you know, some of them aren't gonna thread well together one after another, but I'll try and make sense of these a little bit. I guess just starting out, what are the key advantages of working with someone like you? And you know, what are the fees associated with that?
Well, I think some of the advantages really would be just the number of products that are available, because I get rate sheets from a lot of different banks, not just one. So some bank might have a strong appetite to do a certain kind of loan, and they're really making that super competitive, where another bank is like, no way, we don't want to do that, but we really want this kind of product. And so just being able to pick and choose among a lot of different rate sheets and try to get my client the best terms that I can find. And also just being small and independent, I don't have a staff of thousands where I have to control them with a very strict process. So while there's compliance that definitely has to be met, I can choose not to collect application fees. I don't have to do rate lock fees. I can coach someone into how to look at their own credit for pre-approval instead of just doing that hard inquiry that's going to immediately, take some points away. So being very customer focused, I think is a big advantage of some of these smaller mortgage shops, MDI Mortgage being one of them. And, just being a lower cost option for the banks, and this is kind of leading into the next part of that question about, does it cost more to work with a broker? Banks look to add third-party origination when they're seeking more business and, in a way, much easier business. So they are getting these applications for people that are all put together, neat and pretty, pre-underwritten. They get it, they make sure they like it, and then they can fund it. And they didn't have all the overhead cost of this third-party originator. The broker is responsible for doing their own education, their own rent, their own lights, their own insurance, all of that. So it's really a low cost option for a bank to take on these kinds of loans from a broker. And that was one of the things I saw when I was working for that large national mortgage company before I started my own company. Was there was a retail branch just a few miles down the street from our wholesale branch, and independent mortgage brokers would send loans to our wholesale, and the retail loan officers were getting upset because there were two different rate sheets going out. Headquarters would give one rate sheet to their retail people, a different rate sheet for brokers at better pricing. So then a broker was able to kind of undercut the retail at the very same company. And so working with a mortgage broker should be a lower cost, lower rate. Typically, the way I do this is I get paid by the bank at closing if it closes. So I don't charge upfront fees at all. And if it doesn't close, I don't get paid. It's similar to a real estate agent in that way. And if it does close, then the bank is paying me. So it's really a win-win for the client because they get to work with one person from start to finish, have their questions answered, have different loan options presented, a good discussion on why it might be better to go this way or that way. And but they have this, they're getting this national outreach in a way where just someone finding the best terms that are out there, hopefully. And also just knowing the different underwriters at the bank. Sometimes the terms are going to be pretty standard across a number of different lenders, but there might be something in the loan scenario that makes it a little more tricky. And so it's like, oh, well, I think we're going to have an easier process if we work here because they see things this way. They calculate rental income this way, just some differences that can help the process. So one way or the other, there should be a benefit to working with a mortgage broker. And sometimes there isn't. And those are times when it's who do I refer this to? Who's doing a great job with loans that should be portfolio loans, whether that's a construction loan, a land only, a really unique property that might not meet secondary market standards. That's where I find them often suggesting, well, maybe you want to talk to this bank or that bank, some of the regional banks that don't accept third-party originations. So yeah, I always think it's a good starting point, because it'll either be good advice, better loan terms, or a referral in such a way that will try to help ease the process.
How do you kind of find and vet the banks that you choose to work with for your clients?
I look at whether they hold on to their loan servicing. That's kind of a big deal for people in Maine. They really don't like their loans being transferred. So I try to find a community bank feeling in a more sophisticated, larger bank setting, and have been pretty successful with that. I also look at the appraisal management companies that they use and make sure that I think that's a good fit for rural Maine. And then sometimes it's also on programs. Can they go down to a lower credit score on VA and FHA loans? Can they do bank statement only, where we don't need tax returns but can use business statements? Different niche type programs. That's and sometimes I'll just say no because I don't like the name of the bank. It's like, no, I don't want to I don't want to say this name. It's silly. So it's random.
Understood. And I had one more question on what you were talking about. You mentioned the secondary market standards, and my hunch is that anyone that might listen in on this probably won't really know what that is. Could you explain what the secondary market is for mortgages?
So there's just conforming mortgages would be where the money is coming from, and that's typically Fannie Mae and Freddie Mac, these government-sponsored entities that really came about to add liquidity to the market. So, thinking about the past couple years and where rates were, most banks would not want to take money out of their vault to lend and be promising people 2.5% for 30 years. There's a lot of credit interest risk, and right now we can potentially find 5% on CDs. So it's that inverse relationship. And so Fannie Mae and Freddie Mac fund these loans for the banks so that they can continue to lend, and they're just making a little bit of money when they sell the loan to Fannie or Freddie, whether they service it or not. And they have very specific guidelines that have to be met in order for them to be happy with the loan that they took on. So that's more the conforming, and VA for veterans, federal housing, and USDA, some of the first-time home buyer programs that are out there. And then there are loans that don't necessarily meet those requirements, and they are held on the bank books, whoever originates or buys that loan, and they're collecting the interest at that point in time. But then they get to make their own rules and have their own things that they're okay with and things that they're not okay with.
Sure. Yeah, thank you.
Thanks.
Are you seeing a tightening in lending standards just kind of across the industry?
I'm seeing the opposite right now. So there have been times where there's been definite tightening. After the financial crisis, a lot of lenders even left the market altogether, or if they did wholesale, they're like, nope, we don't want more business right now. We don't feel comfortable. And then even in early COVID times, the rates were just so unheard of And then the future's so uncertain that the servicing values of the loans that were being written was a big question mark. And it ended up that mortgages that were written in March and April and May of 2020 were very quickly refinanced again a few months later. So there was a time then recently where banks stopped doing jumbo loans, stopped doing their more creative type loans, things that would have to be held on their books. But currently, what I'm seeing is there's not a ton of business, and there's still a lot of lenders. And so they're trying to come up with creative ways to add to what they're doing through creative programs, and just a lot of outreach. Like my phone rings all the time with, well, sign up with us. So yeah, I'm not seeing it right now.
Interesting.
What I am seeing, and so there was another question that kind of led into that, are industry trends and what to watch for. So what I noticed is when rates started to go up last summer, and some of that expansion of lending, some banks were offering buy downs. I don't know if you've ever heard of that, but it's kind of a neat tool that people can use in this high interest rate environment. And what it does is it's the seller kind of agreeing to subsidize the new buyer's payment for the first 2 years. So I ran a little scenario, and I'll kind of, I think this might help make the most sense of it. So it's called a 2-1 buy down. There's also a 3-1 buy down. And what it does is you look at what the rate should be. And then for the first year, you look at what would the payment be if the rate was 2% lower. And that becomes the payment that gets made. And then for year 2, what is the payment if the rate was 1% lower? And then year 3, it goes to the regular payment. So I looked at a quick scenario. If the sales price was $400,000 and the buyers were thinking of putting 5% down, that would be a loan amount of $380,000. And I'm going to kind of back into this a little bit. The total contribution from the seller for this buy down would be $8,500. So then I looked at, okay, what if they upped their sales price, because they still want to net, that 400. So they up their sales price to $409. That would put the buyer's loan amount at $388,550. If the rate was 6%, their principal and interest payment should be around $2330 a month. However, if they do this buy down, the first year they're paying that loan amount at a rate of 4%. So that mortgage payment, instead of $2330, would be $1855, almost $475 less for the first year. And then for the second year, the effective rate's 5% in this scenario, and that puts the payment at $2,086, so about $243 lower. And then in year 3 and on, it goes to that $2329. So what we do is we take for the first year of monthly savings times the 12 months and look at how much that costs. It's really just the seller paying the difference. And then the second year, that monthly savings times the 12 months, and it was about $8,600. Now, the good thing is the buyer has a much lower payment for when they're first getting into a home and maybe feeling a bit house poor. The bad news is either the sales price is going up, or maybe they could have had a lower sales price if they didn't do this buy down. So I looked at, what is that difference if it was just a lower sales price the payment would have been $51 lower per month, but not just year 1 and 2 forever. So I think the buy down is a good option if we know that rates are going to come down in the next couple of years and people are going to refinance, and if values maintain. But so that was one of the industry trends that I started seeing last year when rates came up, as a way to try to help people with these rates. And they were almost at 7% last November. Also expanding what's called a non-qualifying mortgage, and that just means it doesn't meet certain criteria, and that's where banks can do, they'll finance investment properties just based on whether that home can cover itself in rental income. So some banks are doing a 1-to-1. If the principal, interest, taxes, and insurance are $3,000 and the market rent is $3,000, someone can get a loan. It doesn't matter. We don't even look at what their other income is. And some are doing 75%. So even going deeper, I find a lot of the regional banks, their commercial lending can also do this. So I tell people to kind of compare rates and see what's better, because those rates aren't awesome, as you can imagine. And also just more different jumbo loans, physicians loans, and what's the other thing that we're seeing with industry trends?
I think my question might play into this a little bit, but is adjustable rate mortgages a big sell right now for that same reason?
They're not great. When I look at the adjustable rate terms currently, and they're trying to look ahead, what are rates going to do? And they're more attractive to banks if it looks like we're in an upward rate environment. So at the moment, I'm just seeing adjustable rates that are fairly, if it's a regular mortgage, they're fairly close or even worse than fixed rate pricing. So, will rates be coming down soon? We have to hope so. And I think that is part of what we're seeing in the pricing. So I am not recommending adjustable rates at the moment, unless it's the only option because it's a more unique loan program. Potentially a jumbo loan. Oh, that was the other industry trend. I'm seeing some banks start working a bit more with Federal Home Loan Bank instead of Fannie Mae and Freddie Mac. There have been more, you may have heard about it on the news, but there's more pricing fees that have been implemented in those conforming mortgages, and especially second homes. Second homes used to have the same exact loan terms as a primary residence until April of last year. And now there's so many more fees that are thrown on top of it. It either is going to cost upfront, or you try to increase the rate to cover those costs. Federal Home Loan Bank has a much lower, they're called loan level price adjustments, and they're much lower right now than Fannie and Freddie. So if someone comes to me and they're looking to finance a second home, I'm probably looking to a lender that is sending those to Federal Home Loan Bank, because I'm going to get better loan terms with that. So yeah, those were some of the industry trends.
Can you talk a little bit about home equity loans and lines of credit? We have a lot of retirees or people who are going to retire soon. And we like to encourage clients to have HELOCs, especially so as a backup, basically,
Right.
for cash. But, you know, with some clients, especially if they no longer have W-2 income, you know, it doesn't seem they're nervous about it. So how does that usually work? What's the impact of, you know, that on the application process?
So the home equity line of credit, I usually tell people get one while it's easy to get one, because when you really need it, it might be more challenging, and it can just sit there and not be used, but be there as a backup, as you say. So if someone's looking to have a home equity line and they don't have W-2 income, do they have a draw from their retirement that can be used? That would be something that would be looked at. Banks often will look at how much the draw is compared to the portfolio. Is there at least 3 years worth of someone being able to take that monthly draw? And if there is, that can be used as income to help qualify. There's yeah. So most are looking at whether there's adequate income to qualify. Asset-based lending is not quite as common as it was.
Are the banks
Before.
looking for that draw to have been in place for a certain period of time, or are they going to accept just like a letter from the advisor, or, you know, a short-term draw that's been in place?
I know with regular first mortgages, I've often looked at how much someone would need to draw, and they have then set it up with their advisor, and they get a letter and it says, this is the amount, this is when it starts, and that's qualifying income.
Okay.
Down the road, do they make a change to that? Maybe.
Okay.
So that would be probably more up to the bank and the underwriter, but I've had really good success with that. And that's my kind of go-to in that scenario.
Great.
There's also a way to look at the total portfolio and kind of attribute a dollar amount. But the monthly draw is just so much easier.
Okay.
And, yeah.
And do you do a lot of line of credits as a broker, or is that less common?
Yeah, I don't. In the early 2000s, there were some really, really great home equity programs available, and I did a bunch of them. And then after 2008, 2009, there was a big shift in that. I'm starting to see banks offer home equities to their brokers to sell, but I don't like the loan terms that much. So I'm still referring home equities to some of the smaller lenders in the state, maybe credit unions. There are some who are, you know, potentially offering prime minus a quarter, or going up to a 90 or 95% combined loan to value if someone needs it. And the larger banks are, I just don't like the pricing. So no, I'm not doing those currently. But if something great came along, yes, absolutely. I would. Yeah, so just looking at, oh, and then there was a question about a construction loan scenario. And the question was, if someone owns their land and they want to build, how does that all work? So typically, if someone is purchasing land and doing a construction, the bank will look at the total acquisition cost, and then the loan amount is a percentage of that total acquisition cost, depending on what kind of equity position they want to be in. If someone already owns the land, even if it's not free and clear, it then is more treated more like a refinance scenario than a purchase scenario. And it's very much based on the appraisal. So an appraiser would go out to that property, the land, and they have the house plans and they have to squint their eyes and envision what's going to be there down the road and come up with a market value subject to its completion. And they send the bank the report. We think it's going to be worth X. And, you know, the land value is wrapped up in that total. So then the bank can feel comfortable potentially setting up their construction line of credit for the entire cost of the build, as long as those numbers work out. But if someone has a loan on their land, it's kind of the same idea, but the very first disbursement from that construction line is to pay off the land loan so that the construction line has a first lien position at the Registry of Deeds. And then here's the value, here's how much we can lend, here's a payoff that has to happen, what's left over, and is it enough to cover the cost to construct?
Got it. And is it typical that in a build scenario, that 20% is still kind of the target, kind of equity that the homeowner's needing to put into it?
That's ideal. As long as the home is in construction, the bank has a lot of risk, whoever has lent on it. And they cannot send this off to the secondary market, until the house is done. So they have to decide what their tolerance is. In the past, I've done, not me personally, but one of my employers was okay doing construction loans with 5% down or nothing down, hoping when it was done that it could flip into the VA loan or the USDA loan. But that kind of went away after, various scenarios occurred, and all sorts of things can happen with a construction loan. People can be not really paid. Builders can put liens, mechanics liens on properties. With construction, everything goes over time and over budget. So it's, banks like to have a bit more equity, but not that there are options. There are ways it can be done, but it's really up to the bank and their appetite for risk. Any other questions or?
I was going to ask, do you see a trend in terms of the spread of rates with percentage of down payments? Between 5% and 20%, is the spread significant?
As far as the rates that are offered for
Right.
that?
Yeah.
It almost is impacted more by credit score at those down payments. So if someone has a very strong credit score and they put 5% down versus 40% down, there's not much of a spread. If someone's doing cash out refinance, yes, that changes things. If their credit is under 680, you can see some really big changes. But interestingly, sometimes 5% down prices out better than 20% down. And the reason being, banks like to have 20% down in case things go sideways and they end up having to foreclose and sell this property at auction. They want to be able to sell it and at least get, cover the lawyer fees and get repaid. If someone has less than 20% down, then they're looking to either private mortgage insurance for coverage, or government entities like the FHA, VA, and Rural Development, USDA. And then if they have to foreclose, they have either this insurance or guarantee coming in and helping them be made whole if they suffer a loss at foreclosure. So they like 15% down, way more than 20% down. And then the next level where we start seeing improvement is 25%. So 25 is better than 20, but 15 is better than 20 as well, oddly. But yeah, that's so definitely credit score has a big impact on loan terms that are offered. And very recently, some of that, you've probably seen this in the news and the big uproar over it, but some of the pricing adjustments that were really penalizing lower credit score borrowers has been reduced, but pushed up the credit chain. So someone with a 710 credit score now has much larger pricing adjustments than they did a few months ago. And people with a 640 it's still pricing worse than the 710, but they're seeing an improvement over what they would have had a couple months ago. And then there are some programs where you either qualify or you don't, and the loan terms don't matter a whole lot unless you're like under a 600 credit score. So there's a lot of variety. And like in your business as well, when you have questions, your answer often is probably, it depends. So that's similar here. It depends.
Awesome.
Any other questions? All right. Well, thanks, Sherri. That was
You're so welcome.
awesome information. We might be in touch with additional follow-up questions.
Yes,
We
please,
would email
please
you.
do.
Okay.
I'm always happy to help. So if you have questions, or if someone's working with a different lender and you just want another opinion on whether it seems okay or not, I'm always happy to offer what kind of reassurance I can, or explanations. And sometimes it's just nice to have another person saying, yeah, that's kosher, that's okay.
For sure.
But yeah, anything I can do to help out.
Awesome.
Thank you, Sherri. Appreciate it.
Thanks, Craig.
Thanks for your